Job openings, the first of several looks we're getting at the labor market this week. And the state of the jobs market, obviously a huge catalyst for the Fed. But some economists saying we need to see a bit more moderation in the labor market before the FOMC can begin to cut rates. So what does this data tell us about the path forward here? To discuss, we've got Veronica Clark, Citi economist. We also have Marianne Bartels, Sanctuary's chief investment strategist with us. Veronica, I want to start with you. Just talk to me about these JOLTS numbers. Markets coming off their lows in response, but not seeing too much upside activity. In terms of the economic picture, how critical is this data in your overall thesis?
Yeah, I mean, I think this is a pretty important data set, but it's kind of painting a similar picture to what we've seen in the last few months, where we know that demand for labor is definitely coming down. You see that very obviously in the overall job openings number declining, but also in a very low hiring rate. That's a really important detail of this JOLTS data. We definitely see that hiring is pulling back. It's still a favorable sign that layoffs are still low, but that would really be the last step of a weakening labor market. And we definitely see signs that businesses are looking to cut labor costs by not hiring.
And Marianne, want to get your read in on this as well as what the Fed is going to be looking for in the economic data coming in the form of the employment situation later on this week, and then additionally a little bit more of a read on the labor situation and employment and labor market more broadly as we get even readings like this as far back looking as they may be for JOLTS. We get a little bit more active with the ADP and brought more in line with the jobs report later on this week too. What's the Fed going to be looking for?
So I think the Fed is looking at a broad set of economic data. Of course, they're looking at jobs. That's very critical. They're looking at inflation measures. Yesterday, we had the ISM manufacturing, and that dipped below 50, a little bit of softness. Prices came down, but the employment number in there actually was a little bit stronger. So now we get the JOLTS, and we're getting some softness. So you're seeing some mixed data. That's very normal. But I really think the Fed is still very focused on inflation. And I do think inflation can continue to come down. And we're still forecasting that the Fed should be able to cut rates by 25 basis points in September. And again, that's as long as the data is supportive. We do think that they'll cut rates. And we think that's supportive of the bond market and the equity market.
Well, I want to talk to you both actually about the big R elephant in the room of a potential recession. Veronica, starting with you. It's so fascinating how quickly things change, right? Because just a couple of weeks ago, we had PMI breaking out. The economy was too hot. Now, all of a sudden, the economy potentially too cold. People freaking out about the Atlanta Fed's GDP numbers. Are you seeing any evidence in the data about a potential recession? And if so, what are you looking at?
Yeah, no, we absolutely do. That's actually still in our base case that we're going to see just further weakening in the labor market, further weakening in activity and spending. You've already seen signs that, in the first quarter of this year and in April, consumption is really starting to slow down. We had those revisions lower to consumption in Q1 last week. Residential investment, which was a really big support for Q1 GDP growth, that is now turning. You've seen housing, turning again, construction falling, home sales falling. And to us, it does look like, this is a weakening labor market on the brink of an even weaker labor market, even further, job loss that we're going to get in the coming months.
So a little bit of pessimism from you there, Veronica. But Marianne, I mean, we're still near all-time highs, right? We're coming off of them, but we're still in this bull market. So where are you on the kind of recession to no recession scale?
So I use anecdotal evidence. I'm not officially an economist. And I'm sure if you've been out at restaurants, they're completely packed, and not just on the weekends. I've been flying the past 2 months. Every flight I've been on has been completely packed. The consumer's still spending, however, selectively. And I think as long as the consumer is spending, I don't see a recession, considering the consumer's such an important component of the economy. But when it comes to the stock market, it's earnings, earnings, earnings. Mm-hmm. And the seasonality of estimates normally start coming down. And what we're actually seeing is the opposite. Analysts are taking their numbers up. And with the strong earnings backdrop, we're still very bullish. We never said sell in May and go away. We actually said buy in May, but sell by Labor Day. Looking for that seasonality correction around September and October. But we're still pretty bullish. We're still looking for 5,600 to 5,800 on the S&P. So we think, there's clear sailing for the markets from here.
Yeah, it's really interesting. It's a great point, Marianne and Veronica. I'd love to get the economist perspective from you because based on some FactSet data during the months of April and May, analysts actually did increase EPS estimates in aggregate for the second quarter. What does that tell you about the strength of the consumer right now?
Yeah, I'm not an equity strategist by any means. We listened to earnings calls, and it did seem like consumers had a bit of a pullback, even consumer equities, in the earnings that we've heard over the last couple weeks, and we definitely see that in the hard data. I mean, it's been 3 of the last 4 months where real goods spending has declined. Restaurant spending in real terms has declined for 4 of the last 5 months. So I do think we're seeing a pullback in this more discretionary type of expenditure. Delinquency rates on credit cards that have well surpassed 2019 levels. It is favorable that unemployment is still low, but as people become more worried about employment prospects, and we see that in some survey data, we see that in the low quit rate in this JOLTS data. If spending pulls back even more, that does create an even bigger pullback for these consumer businesses.
Yeah, maybe that's telling us Dollar Tree will be the most important report of this week here. Veronica Clark and Marianne Bartels. Veronica is the city economist, Marianne Bartels, Sanctuary Chief Investment Strategist. Thank you both for taking the time here with us today.